Thank you very much. Good afternoon, everyone. I'd like to call the meeting of the CERS Investment Committee. This is a regular meeting for today, and we have a relatively limited agenda, so we should have a relatively short meeting this afternoon. I'd like to begin with the opening statement. Would that be read, please?
All right, this is a regular meeting of the County Employees Retirement System Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61-826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you very much. I'd like to begin then with the roll call. Sherry, would you do the roll call, please?
Yes, sir. Dr. Hackbart,
Here.
Mr. Cheatham,
Here.
Dr. Milkman, Mr. O'Meara,
Here.
and Ms. Pendergrass.
Here.
Thank you.
Thank you. We do have a quorum, so we can proceed. Sherry, I don't believe we have any public comments, do we?
That is correct. No public comment for today.
Thank you very much. The first item for our discussion and action is the approval of minutes. We have a series of 4 minutes that we need to consider and approve this afternoon. The first one is on the August 15th meeting. This was a specially called meeting where the focus was on strategic planning. We also discussed, led the discussion of the KPPA strategic planning process. We also reviewed the suggested CERS investment component. And I believe, Betty, you might have some edits. We might want to take these individually, given the fact that you do have some edits to suggest. Is that correct, Betty?
Yes, what I'd like to suggest for to make things a little easier is that I get with Sandy and the tape and try to come up with some specific wording to edit to the minutes and just pull these minutes from today's approval list and bring those back at the next meeting.
So to pull the August 15th minutes, is that correct, Betty?
Yes.
Thank you. Without objection, we'll do that. We also have the August 28th meeting. That's a regular meeting. We talked about the asset allocation ranges, and we also had a fiscal year update and focused to a great extent on the Fed's policy, as well as a budget update. Might take that as a separate action. Would someone move the approval of the August 18th minutes?
So moved.
Is there a second, please?
Second.
Is this the August 28th meeting?
This is the August 28th meeting. That's correct.
Yes. So
Motion has been made and seconded to approve the minutes of the August 28th meeting. Any comments or suggestions or edits for that meeting minutes? If not, we can proceed to vote. All in favor of approving the August 28th regular investment committee meeting, please indicate by saying aye.
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 The next item I have is the September 17th meeting. The September 17th meeting was a specially called meeting where the focus was on the investment policy statement and a lot of discussion about the co-investment language. We also had action on real return investment opportunity at that particular meeting. Would someone please move the approval of the September 17th specially called meeting minutes?
Move approval.
Is there a second, please?
I'll second. Go ahead, Lyle seconded.
Okay. Motion's been made and seconded to approve the September 17th minutes. Any comments or suggestions or edits for that meeting sets of minutes? If not, we can move to the vote. All in favor of accepting the September 17th minutes of the specially called meeting, please indicate by saying aye.
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 Motion passed. September meeting minutes are approved. Finally, we have the October 22nd meeting. Also, this was a specially called meeting focusing on the Kane Energy Fund and the continuation funding. Would someone please move to accept this set of minutes?
I'll make that motion.
Thank you. Is there a second?
A second.
Motion's been made and second to approve the October 22nd specially called meeting and the minutes for that meeting. With any discussion or comments about those minutes as presented? If not, we can proceed to vote. All in favor of accepting the minutes as presented for the October 22nd specially called meeting, please indicate by saying aye.
Aye.
All approved, opposed, motion carries. Thank you very much. So we do have, we'll take up the August 15th meeting after the edits have been dealt with, as you suggested, Betty, if that's okay with everybody. The next item of business is basically our quarterly updates, and I'm going to turn it over to Steve to present those along with our guests from the Wilshire Consultants. Steve, please proceed.
Good. All right. Good afternoon. First, we're going to have Wilshire cover the economic and market update, and then we will jump into performance and allocation. So, Wilshire.
Thanks, Steve. I'm going to take us for a minute to page 21, if we could, please, and make an advertisement for the Wilshire Client Conference next spring. I'll just mention that this conference had a really long history for us, somewhere, I think, close to 40 years prior to COVID. And 2019 was our last annual conference. So we're putting it back in place. Spring of 25, you'll see the dates here on the page, and just want to welcome you all to that. It's a heavy focus on education and research. So you see some sample topics on this page, but we will spend 2 days just presenting through a lot of investment topics that are all relevant to what we're all doing here today. So would love to have any of you be able to attend that next spring. And I'm sure you'll hear this again.
All right, I'll take it from David on page 24 to talk a bit about economic updates, and then hand it back to David to talk about markets. So on page 24, a page that's probably becoming pretty familiar at this point, our quarterly review of rates broken down, starting with the nominal 10-year and then breaking out the real rate and the break-even inflation. And looking at that top chart, you see the trend downward throughout much of this year, the dark line indicating the start of the third quarter. So during the third quarter, rates fell, you can see in that top section, from around 440 to bottom out around 360. Started a slight uptick at the end of the quarter, which continued into the start of this quarter. And David will talk more about rates, but essentially we've essentially round tripped from the start of the quarter through where we are today, back up in the 440 range on the 10-year. You can see that the real rate declined pretty steadily, and there was a more pronounced uptick in break-even inflation expectations near the end of the quarter, which drove overall nominal rates up more than the slight uptick in the real yield. So as the Fed has now started cutting rates, the market is actually somewhat moving in the other direction. We saw a pickup of this after the election too. I think increasing debt levels were expected regardless of which candidate won, but after the election, it seems like the bond market has maybe started to show a little hesitation towards the debt levels, and we'll see. We've started to reverse that trend here very recently. We jump forward 2 pages to inflation. We see the CPI in red and core CPI in blue, that peak in 2022, coinciding with the aggressive increase in rates by the Fed, which is shown in the shaded portion, that steady and aggressive step upward. And then at the very far right of the chart, we can see that the first rate cut, we got 50 basis points during the quarter. You can see that the increase in rates has had an effect, and inflation, it's hard to draw the causality between the two, but rates went up and inflation did come down. How much was driven by rates is hard to say, but the Fed has rates into at least close enough to their 2% stated target that they've indicated now that they're not solely focused on rates. And of course, they reiterated that they're always data dependent, but that singular focus on getting inflation down seems to have paid off, and we're, as you can see on the core, still around 3%, but overall 2.5%, again, within touching distance of their stated target. If we jump forward 2 pages and to a page that's got a lot of great data, but is admittedly tough to read and a bit too busy, we break out some of the components of CPI here. So the bars show in blue CPI and core CPI, and then the one in particular we want to draw attention to is services are in red, with the shelter component of services in purple. So we can see that housing remains a driver of inflation, and services overall driving inflation, whereas commodities, which is goods, has been negative for essentially the entire year, with the exception of a slight uptick in February. So as we've said before, during COVID, people were buying on Amazon. Since COVID, they want to get back out and live their life. So the shift in inflation has followed suit from goods to services. And if we jump forward another page, we see, as another topic that we've mentioned before, is that this shelter component of inflation is sticky. And part of the reason for that is just the calculation methodology. CPI uses an owner equivalent rent, which is shown here in blue, the OE rent component. And we can see in the bottom chart, which is normalized as a starting point of 12/31/20, that blue line has lagged the Zillow rent index and the S&P Case-Shiller home price index. So rents and home prices, you can see a big increase from the end of 2020 to mid-22, and a relatively flattened curve since then. Whereas the owner equivalent rent, that component that goes into CPI, is still lagging those two and in a much more stable trajectory. So because of the way it's calculated, it's going to continue to drip in and drive services, that services component of CPI higher, even if we're, able to, if the Fed's interest rate rises are able to kind of tamp down inflation overall, this is still something that has to play its way through the numbers. So do not expect the immediate drop to that 2% target or below, just in part because of the sticky nature of this part of the calculation. On page 30, the next page, we look at employment, job openings versus employed. Want to point out that bottom chart shows that we're about 1 job opening per person looking for work. So back to where we were pre-COVID, early on in the pandemic, a lot of people looking for work, not many jobs, and then the situation reversed pretty aggressively with a lot of jobs and a lot of jobs for the number of people out there looking for work. So this might suggest that labor force participants don't have the bargaining power they did when, employers were struggling to find qualified candidates, and there were 2 job postings for every 1 person looking for work. Now that it's a more even ratio and more in line with where we are pre-COVID, that might have a downward pressure on wage inflation because of that leveling of the playing field. I'm going to skip a few pages to 34, please. Just want to point out that we've had continued decent GDP readings. The first estimate of the 3rd quarter came in at 2.8%. You can see that 3% here in the top chart was the 2nd quarter reading. So pretty steady, albeit not necessarily anything to write home about. But staying in that 3% range is relatively consistent with what we've seen longer term. The longer term average has been 3.2%. So pretty healthy growth levels. Important to see that continue, hopefully. And then on the next page, the consumer. The consumer, on the other hand, we're seeing some signs of potential weakness in the consumer, which obviously is a big driver of the U.S. economy. We see that consumer sentiment is kind of lingering in that below the 10-year average. We've come off those 10-year lows, but still remain a bit below average. And not shown here, one of the survey questions essentially asks these respondents up to rate their optimism about the current economic situation relative to what they expect to happen in the future. And we currently have a situation where people are much more confident about the present than the future. So pessimism about what's coming, which can often potentially become a self-fulfilling prophecy. If you're worried that economic conditions are moving in the wrong direction, that might flow into your current activities, and maybe you slow down your spending a bit. Although the American consumer never seems to do that when it comes to getting their kids Christmas gifts. Maybe after Christmas, the after Christmas sales aren't as strong as they would normally be, because this ratio of optimism to pessimism, current versus future, tends to be a moderately successful recession predictor. Again, partially in part because it can be a self-fulfilling prophecy. On the next page, we see go from the consumer to business activity. And this just ties back into what I was saying a second ago about manufacturing or goods versus services. Manufacturing PMI has languished below 50, indicating a contraction for several years now, whereas services has maintained a score above 50, which indicates expansion. So these ISM reports kind of relay the same message that we see in the inflation figures, that services is a stronger point in the economy than manufacturing or goods currently. And then with that, I'll hand it over on page 38 to David to talk about some of the market moves that we saw during the quarter.
Thanks, Craig. I'll touch on some of these that are helpful, I think, to set the stage for what Steve will go through with performance. So I'll just go to some major components of major asset classes. This is a whole bunch of data on this slide on the U.S. equity market. And since we are reviewing the quarter end, I'll just point out in that top left chart, the first column titled Quarter, the U.S. equity market, the broad market, which is measured by the FT Wilshire 5000 index, was up 6.2% for the quarter, which gave us a year to date of 20.6. And I'm happy to announce that 20.6 is now about 27. U.S. equity market year to date through yesterday, we are up roughly 27%. So,
Dave, just a quick question, if I might. In terms of the overview of the economy and so forth, with Trump just announcing he's going to move aggressively on tariffs from Mexico, Canada, and China, I assume the outlook that was presented was absence of trying to assess the impact that might have on inflation and on the overall performance of the economy. Have you had any insights, or have you had conversations with forecasters in terms of trying to assess that impact and what we might expect as a result, which seems to be is going to be his first major action in terms of economic policy?
Sure. We have a tremendous amount of discussion about that, and with other parties as well. We do not try to factor in the short term where that might take us. There are a lot of moving variables and parts to that. We have our forecasts in terms of things looking forward are for 10 years and longer. So we have an inflation forecast, but we recognize a lot of things that could drive some of these numbers in either direction. And certainly we're paying a lot of attention to tariffs, et cetera. So I can't say that, as a expectation for that outcome, when we developed the third quarter economic perspectives, there's not something measurable to put in there regarding that, but we're well aware of it. And for us, this is a real-time process. And even in terms of what are our views about the weighting of assets relative to policy and things like that. So
I'd say Trump's pick for the Treasury would suggest that maybe the rhetoric coming from Trump will be tamped down by the people he's actually putting in charge of execution, hopefully.
Yeah, I think that pick moderated expectations, as we saw in pricing, both in the actual 10-year as well as expectations for Fed action. I think we started the month, or right after the election, we were nearly 100% that December we were going to see a 25 basis point cut. I think it's more of a coin toss, as of today's pricing. As David mentioned, we've kind of round tripped on the 10-year from the start of the month. Rates rose following the election. We're kind of back down to where we started the month on the 10-year.
Yeah.
I think the expectation, you're going to hear a lot of rhetoric, and I think that's going to cause a lot of volatility in markets. Both, as you mentioned, Dr. Hackbar, both tariffs, immigration policy, monetary policy, where the markets are, as David mentioned, kind of fighting that out on a day-to-day basis. We saw a big fall in yields yesterday on the nomination of the Treasury Secretary, which we think is, from the tariff perspective, he's kind of on the tape with, it's a good negotiating tool. Maybe it moderates some of the rhetoric as far as the magnitude or implementation of some of the tariffs that, have kind of been thrown about. So, that's something that's, as David mentioned, that's an ongoing discussion every day in the market, something we consider when we rebalance portfolios.
For sure. Yep.
Trump doesn't seem to have a real strong record of listening to his advisors, so it'd be interesting to see what takes place in that regard.
Yep.
With the possible modification, because came up with a pretty strong statement of 25% tariff on selected products, wasn't it?
Scared the loony a little bit. Yeah, I think
Yeah.
Canada had a little bit of a sticker shock with that
Right.
announcement.
Yep. Time will tell.
Along the same line of question, I understand your forecasts are based on the long term, but I really don't like the idea of giving up a lot in the short term either. Your top 2 or 3 areas of risk exposure from asset class right now, what would you list those as?
Well, I think, if you talk about giving up in the short term, probably the biggest potential so we would think of that as drawdown risk. How much, your total portfolio or any particular asset class may decline in a shorter period from a sell-off. And for us, we would say that would be the broad cap weighted US equity market. I just talked about it being up 27% year to date. By any measure, it is highly valued. And, just to answer that question, I think straight up, that'd be our number one area of concern about drawdown today. And actually, if you look back at what we've been through the past number of years, the biggest driver of returns, we often, Steve talks about this a lot, we talk about it a lot, the quote 60-40 portfolio. That portfolio, just hypothetically, or the typical investor who has weighted that way has made large returns. That's been driven by pretty much one thing. That's this U.S. equity market. So that's the area of highest valuation, and we recognize that. We would never take that to zero where we have any kind of discretion, but it could get underweighted a little bit. But that'd be the area that we'd be most concerned about in the short term, recognizing that we too are not able to, no one can really predict where things will be in 6 months or a year. So we just try to manage carefully around that.
On the bond side, what's your thoughts with regard to duration and credit quality at this point? Then?
Yeah, credit spreads are tight today. So in terms of credit, that would kind of coincide with if we have a drawdown in the U.S. equity market, likely to have some drawdown in credit. In terms of duration, this is a tough one, because this is about, the Fed is working hard to try to get stabilized. And you can see, we talk about this each quarter, the market predicts a number of rate declines, and then the Fed brings it down a little bit, and then we get a little bit of harder data rather than soft data, and the market backs totally off. So we certainly think rates will be nowhere near where they were and where they bottomed out at zero in 2021. But we just talked about this Treasury. So the 10-year Treasury went down 60 basis points from June 30 to September 30, produced a 5% return, helped to produce a 5% return to the aggregate index for a quarter. And that whole 60 has been reversed, 50 of it now, but we're back up 50 basis points on the 10-year. So there's a lot of volatility around that. And I think in the short term, we think, it's important to have duration in the portfolio, unlike what we felt 2 years ago. But it's a challenge to think about how to weight that today, whether you want to overweight or underweight it, because in the short term, it's hard to know how things are going to continue to play out as data comes in.
Do you think the Fed will keep its powder dry pending the first month or two of the administration?
Probably. I think the Fed will do what they do based on what kind of data they see come in.
Well, I think it's going to be kind of challenging for the Fed if in fact the tariffs become a driving force in inflation.
Sure.
That's kind of an unusual kind of an economic factor in the Fed's evaluation of the performance of the economy. So that's sort of an artificial impact and so forth, rather than the general performance and strength of the economy. So it'll be interesting see how they react to that, because that's kind of an unusual dilemma they're facing if that actually occurs, which I think, as you've suggested, some of you suggested may not occur, but on the other hand, if it does, because those tariffs look to be pretty significant on major industrial products and automobiles, major consumer items as well. So there could be sort of an artificial impact on, if you want to use that term, I'm not sure it's appropriate, but in effect, it's something we impose on, we kind of create inflation with that policy.
Yeah, all of that will keep the Fed really active. No question. Maybe a couple other things I'll just point out right here about the U.S. equity market for the quarter that we're reviewing. The good news is, along with this strength in U.S. equities, we've had a lot of broadening. If you go to this quarterly column, the second and third lines, U.S. large cap 5.8% for the quarter, small cap 9.1%. So you see a graph of that over to the far right, and every one of those blue bars, when it's above the zero, when it's on the top, that's large cap outperforming small. We know what that story has been for quite some time now. So we just had a quarter where small outperformed large nicely. In a similar way, down below, value outperformed growth. So for the quarter, both of those are signs of just broadening out in that market. This quarter to date, value growth has now taken the lead again, quarter to date. So that trend did not continue, at least not so far. Anything can change in a day, but small cap has continued. And this quarter, small cap stocks are up about 9.7% versus 5% for large cap. So we've had some good broadening. Happy to see that, but certainly a lot of strong performance out of the U.S. equity market. If we go over to slide 42, just touch briefly on non-U.S. markets, and I'll just take the top line of this. The All Country World ex-U.S. index for the quarter up 8.2%. So certainly not like the U.S. market. And then this quarter, that is actually negative. The ACWI ex-U.S. index is actually negative. So not the same thing happening in non-U.S. markets. Certainly correlations are a little bit lower there right now. And so that's part of diversification. That said, U.S. equities continued to be a dominant driver in all of this. So from there, we can go to 43, just the next page up. And we talked about rates, but here to look at the U.S. fixed income market, rates having dropped like we talked about from June 30 to September 30. You look top line and third column in quarter, 5.2% return for the aggregate index for a quarter. Very strong return. That's all from the movement of rates and the movement of spreads as well. And that we've reversed that by a bit. We're running about 2% negative this quarter from the rise back up in rates by roughly 50 basis points. So year to date, we have an aggregate index that is up about 2% as opposed to this 4.4 we see at September 30. So what I would say about all this is there's a lot of reason for volatility. We just talked about the election. We have a president-elect. We have all kinds of things happening. And we have a really hot U.S. equity market. So you took some risk off of the table from a strategic perspective over this past year. And I think that's been a great place for you, and your staff and team are, they focus on this constantly with rebalancing. So just know that a lot of this is moving quite a bit in any short-term period, and you're managing through that well.
What are other states doing in that regard?
Well,
Are they backing off of equities as well? Modestly?
yes, there have been a lot of examples of that, and we've recommended that in a lot of cases over the past year, where just like in our discussions here, that you've had the opportunity in this market over the past year with rates going up. You've had the opportunity, and then forward expectations on equities coming down. You've had the opportunity to reposition risk without sacrificing return from a 10-year forward-looking expectation. So we're not alone in feeling that way, and you're not alone in feeling that way. And so certainly not every fund has taken advantage of that, but plenty have.
Well, and as we talked about during the IPS asset allocation discussion, a lot of plans, and Wilshire did a great job of presenting, a lot of plans, we'll go back 3 years, were forced into extending out the risk spectrum because, again, yields were near zero, didn't offer much as far as a ballast or as a pickup. So that opportunity set has changed pretty dramatically, with any yield type of investment offering a much more attractive return profile than it did 3 years ago, certainly. And what we see for expectations, starting point is pretty meaningful for forward expectations of performance. So I think the bulk of what you'll see, at least on the public side, is asset allocation shifting away from equities into more assets that have a yield component.
Yep. So Steve, I can turn back to you.
Dave,
Perfect.
one second. David,
Sure.
you didn't cover page 23 of your presentation. If you don't mind, can you kind of flip back and
Oh, yeah.
Yeah.
Sure. So yeah, these are our capital market assumptions. So
Didn't catch what page?
23, I think, Sherry. 23, Terchita?
Yes,
Yeah.
board books, yes.
Yes. So yeah, thanks. These are, and this kind of talks, we'll show in numbers what we've been talking about with forward expectations. These are our capital market assumptions. They're 10-year assumptions, but we revise them at the end of every quarter. So that just means we simply take the valuations and the yield levels and everything we see at each quarter end and project out over 10 years what we would expect from assets. So the first, I'll just point out what is striking here is what we've referred to as a negative equity risk premium. The equity risk premium is, that's the definition of the difference in return between stocks and bonds, stocks minus bonds. Long-term equilibrium type of market levels, that's always a positive. Right now, when we look forward, you see the first column in the U.S. stock market, we have a 4.25% expected return over the next 10 years. And if you go halfway across this page to fixed income and look at the core bond, that is 4.6. That's the stocks minus bonds measure, which in this case is negative. So some may take issue with that. I can tell you there has been a lot of work done on that here internally, and other firms do a lot of work on this as well. It's a unique time. I think this is our third quarter in a row of having a negative equity risk premium in our market assumptions looking forward. And that is coming from the valuation levels we've seen in this U.S. market. You can see that in non-U.S. markets, it's not as bad looking forward 10 years, but that comes from the valuation levels that we've seen. So when we look forward 10 years, we're starting at this, up 27% year to date that I just talked about a little bit ago. we're starting from that point and going forward 10 years. So that's the most telling thing here. A couple other things I'll point out. You have significant allocation to things like private credit, and you look over to a little bit further from that core bond column, you'll see private credit with an compound return expectation of 7.8. Great place to have asset exposure, we think, and you have that. In fact, you've increased that a bit in your recent policy work. You can see the difference between that and equities right now. So private credit, 7.8% expected return over the next 10 years. That's been a good area for you. We think it will continue to be a good area for you. So
Private equity hasn't performed that well recently, though, correct?
well, depends. Well, it depends on the manager and the
Relative to public equity,
pardon me.
relative to public equity.
Right. Public equity has knocked the cover off the ball. And when that happens, private equity is such a different animal. It is as you know, it's a 10 to 15 year investment. It's very long term. It is not mark to market daily at all. When public equity markets are running like they are now, up 27% a year, it's apples and oranges. Like, we don't try in a year or 3 years or 5 years to compare private equity to public equities, but long term. So that's why you read a lot of things today that will say, oh, and institutional investors should get out of these private markets. Public markets are where to be. Most of that is looking backwards. And that's because we've had the returns we've had in public markets. Long term, we do believe that private equity, but long term, as in your kind of long term, you're a long term asset owner investor. We expect private equity to outperform public equity markets. But I know Steve's talked about this a lot in performance reviews. In fact, we've all talked about that. 3 and 5 year periods, you're going to see these differences. To some degree, it's an accounting issue.
What would be the theory why private equity would perform better in the long term?
So a big part of the theory is the opportunity to invest in companies that are private. If you think about a big component of the private market, it's buyout strategies. And a lot of this market is perhaps a first or second generation business that is being sold. And often a first generation business, I'll just give this as an example, there are many more, but often a first generation business has not been run all that efficiently. And so a private equity team can buy that business, add a tremendous amount of value, make it run more efficiently, and just create a multiple expansion on the company that is unlike what you normally would do in public markets, where everything is trading daily. Research flows rapidly all over the place. There's in public markets, there's less and less that one can research to uncover an advantage. Certainly in large cap US equity, that's a problem. Other places it's easier, but private markets are totally different. And today we have more private companies than we do public companies. So it's a good asset class, a good place to be. And investors are the point is to be paid for the long term, the liquidity lockup. It takes an ability to have some illiquid assets to be in that market, but the rewards are there.
Yeah, I think it's a different opportunity set. As David mentioned, it's the illiquidity premium and the efficiency differences that really lead to kind of the spread between public and private equity.
I think the two keys that you're referring to are just taking advantage of the inefficient market, but it also depends on making good manager selections. Wouldn't you agree?
Absolutely.
Oh, yes.
I'm really, one of the points I guess I wanted you to kind of touch on or bring out is on the risk premium. If I'm looking at your charts correctly, you're looking at pretty similar returns between your forecast on public equity and even development. and emerging markets versus the fixed income side, but you're taking half the risk with it.
That's right.
That I think that's key at this point. I was wondering if you all had your projections charted anywhere with each of these asset classes going back over the last, let's just say, even 5-year period of time.
Yes. We,
I'd really like to see that graph.
yes, we do have those charted. We publish those once per year in our annual asset allocation paper, which comes out in January. So, but we'll be happy to share. The most recent one would have been, 9 months ago or so. And we'll have a fresh one of those in just a few months. But yes, we show that. And the earlier part of your comments, Mr. Cheatham, about the difference between stocks and bonds, you're absolutely right. You compare the risk, you compare the expected return, and that is what drove the discussion that we all had here over the past year about taking advantage of that in your strategic allocation, and you've done that.
Please proceed.
Great.
Are you through, Dave?
Yes, I am. Thanks.
Okay, Steve?
All right, Sherry, if you could turn to page 50, please. I think we touched on a number of things I'm going to cover here, so apologies for being repetitive in some regards. But despite the bouts of elevated volatility during the quarter, the portfolios had a strong start to the fiscal year. The CERS pension composite produced a return of 4.90%, while the CERS insurance composite returned 4.78 for the quarter versus a benchmark return of 4.77. With individual portfolio performance ranging from 4.7 to 4.92, and 3 of the 4 portfolios outperforming the benchmark during the quarter. From market perspective, despite struggling early in the quarter as rising fears of a U.S. recession led to a sharp rotation out of growth, as David mentioned, and into value stocks in the public equity markets, they began to stabilize in August as stronger than expected data alleviated some of those near-term recession fears, and were able to strengthen further in September as the Fed began easing cycle by cutting rates 50 basis points and ended the quarter as the best performing asset class with a return of 6.69% for our public equity portfolio. Core fixed income also had a strong quarter, as David mentioned, with the fall in rates. The benchmark produced a return of 5.20%. As yields fell across the curve, with the drop accelerating with the rate cut in September. Real estate markets continued to struggle, with benchmark posting its 6th consecutive quarter of negative performance with a negative 66 basis point return. Importantly, over the last 12 months, with broad U.S. public market indices reaching all-time highs, including the S&P having its best 9-month start to a calendar year since 1997, the portfolios have produced very strong absolute performance, with the pension composite returning 18.79% and the insurance composite returning 18.73%. Over the last year, public equities have been the best performing asset class by a wide margin, producing a return of 30.10%, while real estate has been the worst performing, declining by 590 basis points. While October performance is not yet finalized, the portfolios did give back some of that first quarter's performance and were down an estimated 125 to 150 basis points as markets cooled with strong economic data sparking a repricing of Fed rate cuts that we discussed. So far in November, markets have been very mixed, with U.S. equities up sharply for the month while non-U.S. equities are down. Interestingly, as David mentioned, small caps have really been the star performers this month, with the S&P Small Cap 600 up almost 12% month to date. And that's on pace for a top 5% monthly return since the index inception in 1994. Core fixed income is back to nearly flat for the month as of today, after falling with rising yields immediately following the election. Real asset markets have also been mixed during the month, with infrastructure and natural resources catching a bid, while tips and energy transition markets have sold off. The biggest winner for the month appears to be cryptocurrencies, with Bitcoin up over 40% month to date. The results of the election may initially boost, our view is it may initially boost U.S. and global activity, but may lead to slightly lower levels of U.S. and world GDP over the longer term, with investment prospects dampened by uncertainty and higher cost of capital, amid concerns about higher debt issuance by the U.S. government and other governments, along with higher inflation expectation. Higher rates and volatility may become the norm as the new administration pursues expansionary fiscal and trade policies, which means a much more uncertain world. As we talked about with the Fed will really have to wait until fiscal policy is implemented before recalibrating their monetary policy. So that points probably to maybe a December cut and then a pause, or potentially, the markets again are pricing in, as of today, a 50% chance of a rate cut in December. Likely a pause at that point to let the impact of the initial cuts, as well as to kind of get a better read on what the extent of fiscal policy is going to impact both growth and inflation. Page 52, please, Sherry. This is the new report that we started including at the last investment committee meeting that shows the performance for the internally managed portfolios. While this information has always been available in the full asset class performance reporting, we wanted to break it out, these portfolios separately. As you're aware, the majority of these assets are managed passively and intended to provide inexpensive beta exposure to more efficient markets while providing staff flexibility and rebalancing the overall portfolio allocations. Additionally, staff manages a number of proxy portfolios which serve as transitional positions for alternative asset classes as we look to deploy capital in new mandates or have capital already committed called by managers. These proxy assets are intended to provide exposure to liquid assets with similar risk and return profiles and economic characteristics as their target private asset classes. This reporting, just a note, is done at the trust level, and not all portfolios have exposure to all of the proxy portfolios, and individual portfolio exposures are reported on the unit holding report found later in the material. All of these portfolios performed in line with expectations in markets during the quarter, and I would also highlight the scientific beta portfolio, which is one we specifically discussed at the last investment committee meeting. This factor-based portfolio outperformed during the quarter with the rotation in the public equity markets. And while this portfolio's longer-term performance has been consistent with the strategy, we are in the process of evaluating public equity alternatives that may be a better fit for the overall portfolio allocation. Page 66, please, Sherry. This is a new report that's in response to requests that we've received from trustees. We're working with BNY to develop asset class level performance reporting for the individual CERS funds, which we hope to include going forward. I would note, currently, given the accounting and data structure in BNY systems, and some of those decisions are legacy decisions that we made and we directed BNY, we're currently only able to provide this performance detail on a gross of fees basis, as noted on the report. So all of these returns for these asset classes are specific to each of the funds, but however, they are currently just reported as gross of management fees. I'll pause there for questions, as that's a new report, if there's anyone has any questions on that. If not, Sherry, you can go to page 68, please. For the quarter, across portfolios, the largest contributors to our outperformance were the relative outperformance in the real return and real estate portfolios and the overweight to public equities, while underperformance in the private equity portfolio relative to its public equity benchmark was the largest detractor from performance. The real return portfolio produced a return of 6.70%, which outpaced the return of the benchmark by 573 basis points. The portfolio's performance was bolstered by strong performance across the recently approved and funded real return mandates, all of which outperformed their benchmark during the quarter. The portfolio's MLP exposure continued to produce solid performance with a return of 5.99% for the quarter versus its benchmark return of 72 basis points, and is up over 33% over the last 12 months as strong cash flows disciplined CapEx and consolidation have continued to benefit the industry. The real estate portfolio produced a return of 1.71% during the quarter, outpacing the benchmark's return of minus 66 basis points. Relative outperformance was driven by the portfolio's open-ended core strategies, which were able to produce positive performance during the quarter, although the last 12-month performance has remained negative. These strategies have benefited from lower exposures to the most stressed parts of the market, including the office sector. Over the past year, the real return portfolio has outperformed its benchmark by almost 11%, which has contributed close to 150 basis points of outperformance at the overall fund level. And conversely, as we've discussed multiple times, the private equity portfolio has underperformed its public market benchmark, the Russell 3000 plus 3% lagged 1 quarter by almost 23%, which was responsible for between 175 and 225 basis points of underperformance at the overall fund level. So if we look at 1-year returns and underperformance relative to our overall benchmark, that has been the most significant contributor by far. Page 76. Thanks, Sherry. While the portfolio has performed well in absolute terms, as expected, given their lower overall risk profiles and lower allocations generally to public equities, they underperformed in the broad Wilshire peer universe over the last year. Again, that's a year where U.S. public equities hits all-time highs multiple times. The lower risk profile of the funds is evident in their standard deviations relative to this peer universe shown in the middle graphs. And as we've discussed, the most significant driver of relative performance and risk for these portfolios is the differences in asset allocations, which is one of the reasons we focus on the Sharpe ratio or the risk-adjusted performance in that last and the far right graph. All of the portfolios have continued to deliver top decile risk-adjusted returns over 3 and 5 year time periods, which really demonstrates the efficiency of their construction and management. The Wilshire All Public Plans universe, which is the universe that we're showing here, has a very broad and diverse composition. And while it provides a good perspective on relative performance statistics, we are working with Wilshire at potential options to customize additional peer composites that would be more aligned with the CERS portfolios and might provide a better comparison of relative performance. Page 84, please, Sherry. Thank you. During the quarter, staff opportunistically trimmed the portfolio's public equity positioning consistent with the revised IPS asset allocation targets. As of the end of the quarter, we maintained an overweight of approximately 3 to 4% across portfolios to the public equity asset class. And that's really based on continued market momentum and economic strength. We've been opportunistic in taking down that overall exposure, but we haven't cut it all the way to target yet as we still see potential short-term or near-term upside. And while the relative overweight to non-U.S. public equity that we had last quarter performed well during the quarter, recent rebalancing activity has been focused on moving the portfolios to an overall neutral stance. And most recently, we've begun implementing a relative overweight to U.S. public equity markets based on a divergent economic and growth prospects. Similar to David's comments, I think there's not to catch a falling knife. The starting point bias for valuations is important for near-term performance. But kind of given the current headwinds and tailwinds of both markets, we've implemented a slight overweight to U.S. markets relative to non-U.S. markets in the public equity sector. Again, to Mr. Cheatham's question, in core fixed incomes, we're currently neutral overall duration. It's difficult to find a compelling case to implement a duration overweight or underweight. We really anticipate a range-bound trading environment over the balance of the year. As we've seen, that range has broadened out a little bit. We're kind of in that 40 basis point range, certainly month to date. Right now, we're exactly at the midpoint. The 10-year currently is 4.30%. We'll expect noise, headline driven. As we saw yesterday, there was a collapse in yields based on a nomination. We expect that to continue. So I think that's a difficult trading environment, and it's difficult to really get a high level of conviction in implementing a long or short duration at this point in time. The largest underweight for the portfolios was in real return and private equity, with the insurance portfolio slightly below the ranges established for the real return asset class. Managers have continued to call capital in the real return portfolio, and we are in the process of evaluating additional mandates and would expect all of the portfolios to reach their target allocation by the end of fiscal 2025. We have maintained an underweight to private equity target allocation as we've seen limited value in the asset class from a relative basis with better risk return opportunities in other asset classes. We have, however, begun to focus more on the asset class as recent underperformance and funding difficulties have created a more attractive landscape in our view. So we are looking at some opportunities and may potentially bring those before the investment committee in the coming quarters. Page 97. Thank you, Sherry. As of the end of the quarter, there were 2 issues identified as not in compliance. The allocations of both pension portfolios and the CERS insurance portfolio to public equities passively managed by KPPA staff by the amounts noted in the report were slightly above that 20% limit. Part of our rebalancing activity has been to address this non-compliance. We've used that rebalancing activity to bring down these exposures and expect to be in compliance by the end of this current calendar year. Last quarter, all 4 portfolios were out of compliance and all have been reduced anywhere from 150 to 200 basis points. So we'll be within that 20% constraint by the end of this year. And that's the calendar year, apologies. The real return allocation for both the insurance portfolios as of the end of the quarter were below the 4% minimum of their allowable range at 3.6%. With recent capital calls, including the first from the new farmland manager, the portfolios will be in compliance by the end of this quarter. We are also in the final stages of evaluating additional real return investment opportunities that we expect to bring before the committee early next year that will move all the portfolios closer towards their targets. Unfortunately, Carrie Bass can't be here today. She was not feeling well, but I'm excited to report that she has started the new compliance officer position and has already begun working on overhauling the compliance function and reporting, which we hope will be a significant enhancement. It's something we've had on our docket since we lost our last compliance officer. So I would expect in the next 2 quarters, you'll see revisions to this and probably an entirely new format to the compliance reporting. So we're excited for that. Page 121, apologies. Through the first quarter of fiscal 2025, actual expenses were below target with a total of $2.04 million or 16% of the budget spent year to date. Consulting and contractual services where we have higher visibility were in line with 20% and 32% of the amounts budgeted spent in the first quarter. And similar to prior quarters, the total for overall legal expenses is the outlier and remained well below the amount budgeted with only 7% spent year to date. As a reminder for fiscal 2025, legal expenses were increased by $1.9 million or 38% from the prior year. And that really was in anticipation of activity increasing as a number of cases move forward, resulting in commensurate increases in expenses. We still expect that by the end of this fiscal year. So those numbers should increase pretty substantially. Yes, Betty, sorry, just noticed you have your hand up.
Yeah, no problem. There's a lot of volatility among the years for Wilshire. Are some of these prior years cash basis rather than accrual basis?
So I do think we had a reduction in the overall fee, which is probably not reflected. I'm not sure we go back far enough for that, David, or not. There was one year that is that fiscal 2023 where there was a delay in reporting. I think there's one additional. Yeah, you're exactly to your point when they were actually paid versus the period for which they were paid for. So we've tried to normalize that back to 4 quarters of fees for every fiscal year is what we're trying to report. So hopefully we're right on budget. The other things I would highlight on here would be the Solovis line item in the contractual services. That, as we know, is billed on an annual basis, and the amount shown for fiscal 2025 is the full year for the fiscal year, so we won't see an additional invoice for the remainder of the year. We also have a line item that was approved in the fiscal 2025 budget for a new private markets consultant, which is something we anticipate doing a search in the second half of the fiscal year. Betty, I'm not sure, did you have another question?
Nope, I just forgot to lower it.
Okay.
My bad.
No problem. No problem. Page 124, please, Sherry. Thank you. As the table highlights, for the first quarter, investment fees and expenses across the pension and insurance trust were 4.2 million, or 7.4% more than in the same period last year. But that's against a total asset base that's increased by 19%. There's significant volatility as to the composition of total fees and expenses over time, with the largest drivers being the variability in performance fees and miscellaneous fees. The sharp increase we've seen in miscellaneous expenses over the last 2 years have been driven by the significant increase in short-term borrowing rates for managers that rely on credit facilities as part of their investment strategies. Remember, we went from essentially a zero rate environment to, the 10-year now at 4.30. Short end of the curve, the 2 years at 4.25. So short-term borrowing costs have gone up substantially over the last 2 years. And focusing just on investment advisory fees, which are those base fees the system pays to external investment managers, I would note the consistency across time. There's been a 5% increase in fees since 2021, and that's despite a 50% increase in total assets. So that's a testament to the efficiency of the fee rate that we're being charged by external managers. I would also highlight the reduction in core fixed income investment advisory fees, which are flat compared to the same period last year, and that's despite a 48% increase in market value. And core fixed income fees are also 520,000, or 43% lower than they were in 2023, while core fixed income assets have increased by 50%. And these reductions were driven by that rebalancing of the portfolio, including bringing a sleeve of that portfolio in-house, which, as we've mentioned, ultimately we expect to reduce fees by $1.5 to $2 million per year for the asset class. Page 126. We talked about this in the meeting yesterday, and I'm going to have some enhancements in the next report for Betty, but this is the same fee information that's reported on that prior page, but it's broken down to the portfolio level. And while we discussed it, it's not precise. Using a simple methodology of just annualizing the first quarter fees, it does provide a good approximation of the fee levels for each of the asset classes. And just to highlight here, the effective rate of base investment management fees for both the CERS and the CERS hazardous pension portfolios is about 32 basis points. And accounting for the performance-based fees from the first quarter, the effective fee rate is approximately 62 basis points. The difference compared to what we saw at the total trust level, if you were to do a calculation, is really driven by the overall asset allocation differences. Obviously between that total trust and what's in the CRS portfolios, we have a higher allocation to public equities, a lower allocation to core fixed income, as well as the composition differences within each of the asset class. And that can be the case where, one of the systems may have a manager that a different system doesn't, or we have legacy issues in private equity where most of the other systems private equity investments are in runoff, where we still have active private equity in the CRS portfolio. As we know, K took a hiatus from funding private equity for a number of years due to liquidity concerns, which did not impact the CRS portfolios. So I'll stop there and see if there's any additional questions.
Steve,
Yes.
this question, I guess, from both you and David, going back several pages, it's not worth going back to, but it seems to be, and I know we've talked about it before, my question to you all is, have you all started talking about finding a better benchmark for private equity?
We've had discussions, and Wilshire has provided some material on, again, it's unfortunately, I wish there was a great answer to that question. if we look across how other public pensions do it, it's a pretty wide range. It's not uncommon to use this public equity benchmark plus a spread, which is kind of that assumed objective or bogey outperformance by private equity. And it just gets exacerbated when there's significant performance differences between the markets over a short period of time. Private markets are going to lag both on the upside and on the downside when public equities are more volatile. I think the answer probably is going to be to use something that's a short term and a long term. We had that in place at one point in time. I think that makes a lot of sense. Something that's more market specific, so actually reflective of private equity performance over the shorter period of time. And over the longer period of time, I think using that public equity plus a spread really is an objective of the program. So over the maturity, the full cycle for private equity, that's what we should be, that's our objective to achieve that public equity plus a spread. But over the shorter period, again, given the long time horizon of these assets, the delay sometimes in realizations, ultimately you don't know the return until you realize the entirety of the portfolios. I think the shorter term, we can probably come up with something that's a little more reflective of the actual performance of the portfolio.
I know it's relatively new to the public space, but there seems to be more products coming to market in the public space that are actually private equity based. David, have you all looked at that as a potential component?
I'm sorry, what was the last part of that? Public markets that are more private?
There seems to be in the public space several new investment products coming to market that are actually private equity based investments.
Yes.
Is that a possibility to be able to factor that one of those indexes in order to get a full reading?
Yeah, you mean just for benchmark reporting?
Yes, as Steve pointed out, that seems to be where the biggest lag in our determinant in our underperformance is. If we can tighten that up, we will get a much truer number.
Right. Yeah. So there's two things there. Certainly there is a proliferation of products coming to the public markets that are attempting to bring private investing to the public markets. So there is that. They have a variety of benchmarks for those. As Steve said, the work that we all presented a few meetings ago, we talked about some different options for private equity benchmarking. One of the things that we've talked about in the short term, you get these differences, and that's what we're always dealing with. The most important thing we believe you can be doing, and you do this, is that you track the internal rate of return, the IRR of your private investments relative to a public market equivalent. And that is, we presented that, Steve, we presented that a few meetings ago, where literally all of your private equity investments all the way back are calculated with an IRR, and then it's compared to public markets by investing hypothetically the same exact cash flows in and out of the public markets. The goal there is to be outperforming those public markets, and you are by over 2%, 2 percentage points annually over that long-term period. So our view is that's the most, when you invest in private markets, that's the most important measure that you have, because that proves that you are achieving that premium return relative to public markets. When it comes to benchmarks like we look at here that we call time-weighted benchmarks that roll up in that total fund performance, that's always the challenge. Finding something, you can do the public markets plus a premium like we've talked about and like you do, or you can have, as Steve said, a short-term and a long-term measure, something in the short term that reflects the current market environment so that you don't kind of get as much of a distorted difference between the two. So there are things that can be done there. You're not alone with this challenge.
And there are a number of, there are several, we're taking a look, there are a number of service providers that produce, there's benefits and drawbacks to them that do produce broader private equity or private asset class benchmarks. I think we just have to be cognizant of their methodology and what they're including. I mean, and how granular we want to be. Again, even a broad private equity benchmark by a service provider may not really be reflective of our private equity portfolio. It may not have the same vintages. It may not have the same strategies, but at least it might give us an idea of how the broad private equity market is performing relative to our investments. I think that's really the intent. So yeah, we will certainly come back to you with some suggestions as to some alternatives that we might have to both calculate benchmark performance as well as to evaluate the performance of the overall portfolio.
Steve, if you could do that, it probably would be good to include that in one of our next meetings as an agenda item. If
We
you
will
feel
do that.
you'd be ready to do that, say, I'm not sure when our next regular meeting is. I assume would be February, is it? Not sure. But anyway, set a goal of when you might be able to present. We can have a good lively discussion of that and give us some background on options and so forth. So I think it would be worthwhile.
We'll plan on presenting it at the next regular investment committee meeting. We'll work with Wilshire, and then if we have a delay or we need additional time, we'll
Sure.
let you know.
That'd be fine, Steve. You bet. Any other presentation materials for this afternoon?
That's all for me.
Any
No.
other questions or comments from anyone? If not, thank you, Dave and Wilshire guests here today, and Steve and staff. And without any additional items on our agenda, we can call the meeting adjourned. So thank you.